Good day, fellow investors. I recently analyzed an European REIT and I got a lot of questions about what about STOR Capital, what about this REIT. So in this video I want to quickly give an overview of what investing in REITs means, and then give the key elements of STOR Capital, what can you expect as a return, make a valuation as always, and you can play around with the template that is downloadable, of course, in the link in the description below. Let's start. So when it comes to investing in REITs, interest rates are key. When interest rates are low, then everybody is comparing the dividend you get from REITs to other opportunities with interest rates. So dividend yields go lower, stock prices of REITs go higher. If we look at current interest rates, we are at 0. You can get 1.5 from the 10-year note, and this is the comparison that is done, especially in United States, in Europe. If we go back to 5%, 6-7% from a treasury, then people are going to expect also 7-8% from a REIT. And if that happens, then you will see stock prices being much lower. So when interest rates are higher, required returns higher, you see low prices. When interest rates fall, then you see higher prices because of the comparison. Of course, now we are in difficult economic times, so there are other things that can hit REITs too, like paying rents, etc. The next benefit of REITs is that no matter what happens with valuations, funds from operations should be relatively stable, especially if you have good tenants that pay long-term lease contracts. So that's also something interesting to watch as a safety measure, as the fundamental measure that you watch when you invest in REITs. Also, if you want real estate exposure for your portfolio, you don't want to clean toilets, repair toilets, then also REIT is a way to do that, where they do it for you. Of course, at a fee, and you are not the owner, but if you are aligned, if your interests are aligned with the REIT's management, then it is a nice opportunity to just click buy real estate and do nothing. So let's start with STOR Capital. If we look at Buffett's portfolio, here it is. He owns about 9%, 10% of the company. So owned by Buffett, really good business does, and you will see it is really a good business because it is a diversified retail triple net lease, which means that they just finance the property and the retailers have to pay insurance, have to pay rent, of course, and have to pay for the maintenance and refurbishments of this. So it's a really clean, mean business machine. They analyze all the retailers, whether they can pay. They require unit financing reporting from the retailers. So really interesting, detailed, well-managed company, and that is also why it is owned by Buffett. So nothing wrong with this net lease business model. Really did well in the past, good assets. There is, of course, debt, but it stands apart with a fortress balance sheet, so nothing wrong there. And you can go through their presentation. It is diversified across industry groups, so from restaurants to early childhood education, health clubs, whatever you can imagine is there. So they look like a very good diversified, but mostly retail investment. So they really got hit, of course, with COVID, but still managed to have good funds from operations. This is the value that a REIT creates for shareholders over time, and then they can decide whether they distribute. They have to distribute a lot of the profits, but keep in mind depreciation. The good things with REITs is that a building actually doesn't decline in value, but depreciation is an accounting cost that allows you to pay less taxes. So there is a difference always between net profit and funds from operations, because once you build it, you have built it, and you can, from an accounting perspective, depreciate it so that you pay less taxes. So they have to pay out 90% of net profits, but there is also the difference there in the depreciation that lowers the profits compared to funds from operations. And this is what you have to use in company valuations. 460 million is what they make in a year for you. But there are also risks. You can see here collections, how those crashed, especially when the stores were closed. Now they have recovered, so as there is reopening, things are recovering, but as they are diversified, so they managed to do well, and the funds from operation wasn't even hit that bad. Let's go to our template. So I will be filling this, you can download this. So we are STOR, the valuation table. I have put $500 million just to make a round number. If they pay out 90% of the funds from operations in dividends, I have discounted that, and then if we get a 5% dividend yield in 2030, then the intrinsic value for a 10% return based on 3% growth rate in the future, which can be higher, the intrinsic value for a 10% return is 8.58 billion. If we compare that to the market cap, so even now the company, if all else remains equals, is giving you a 10% return over the long term. If we look at higher growth over the next 10 years, 5%, and a 4% required dividend yield, then the present value is even higher. If there is no growth and the dividend yields go up, required dividend yields go up, interest rates go up to, let's say, 7%, then the present value is much lower. And this is also the risk of the company. If interest rates go up, then you can expect a much lower interest rate, alongside other risks which are economic, competitive, a lot of those that can hit REITs. So always keep in mind that it is interest rates, competition, economic situation. If tenants don't pay, then you have an issue. So that was retail. Douglas Emmett, again an American REIT, and focused on offices in LA and Honolulu. So a business REIT. We're just going to take a look at the net funds from operations, around 350 million. I have put 370 million here, discounted, with a payout ratio of 6% because they keep the rest for growth rate of 5%, terminal multiple of 20, intrinsic value of 6 billion. If they grow faster with a 4% dividend yield, we are at 8.35, and also if they don't grow and higher terminal multiple, offices are usually more risky, so 10%, especially with COVID, we don't know if people will return to work, then we are at a valuation of 5.87 billion. We compare it to the stock price and we are there for a 10% return, but always mind the risks. The key is that investors know that interest rates can go up, thus the value of the REITs, the stock prices, the real estate would go down, so that's always a risk, and that's why they need a premium on investing in REITs. That's the story, so always keep in mind that this can get ugly. We have had 40 years of declining interest rates that were a huge tailwind for REITs. If this happens, 20-30 years of increasing interest rates, that will be a huge headwind for REITs, and that's also the biggest risk, the elephant in the room, and you never know how long the party will continue to go with very, very low interest rates. If we look at their effective interest rates, those are very, very low for Douglas Emmett and other REITs, just 3%, which is really low. If this doubles, goes let's say to 7%, then also the payments, the interest rates double, and that is a burden on funds from operations alongside higher required yields, and that could be very detrimental to stock prices. Then another interesting REIT, SmartCentres from Canada, and of course again hit by the economic situation, so always to keep in mind that with REITs, but things are improving. They have a solid tenant base from Walmart and all the other shops that go around Walmart. And then there is something very, very interesting. So each REIT is specific, and you have to see, okay, what is priced in the price, and what is the future potential? How is the REIT going to grow? How is the REIT going to give me additional value? And SmartCentres has a very, very interesting proposition. So they have these Walmarts, and they want to build city centers next to their Walmart. So that's the plan. They have a lot of properties, low land utilization, and they want to intensify the usage of that land in Canada, which is a very, very interesting business proposition. And practically what they want to do is this. So this is how current retail REIT looks like, and they want to intensify it by building towers, etc., etc., to increase the value, of course, of the land and of the property there, the rents, etc. So that's very interesting proposition. They have been doing greatly, and they have outperformed the REIT index in Canada and the normal Canadian stock index, but they are paying 80% of cash flows out for 90% for dividends, which is good. Free funds from operations is 2.26 per share, which we'll use in the opportunity, and I think there is about 3 billion to 5 billion that they think there is additional value coming from that intensification and more building coming on their properties. So if we compare that to the stock price and the market cap, 2.2 funds from operations on a 26 Canadian price is a 8.78% yield. If we look at the market cap is 3.83 billion. If we add 3.5 billion to the hidden value there, then that is a very interesting proposition. You practically get paid while you wait. If we go to our intrinsic value table, here we are, so putting in the dividend yield, 10% discount rate, just 3% growth, and a terminal multiple expecting a dividend of 6%, the intrinsic value is there. Of course, there are risks. We have seen the stock price, really the stock price plummet during the crisis as there was issues about retailers paying and not. So there will be such issues in the future too. But then if you're a long-term investor, you have to see how the longer term, if there is higher growth, then the stock is really, really undervalued now for a 5% expected return. So this table, as I said, will be filled, and I will all the publicly analyzed stocks that I make a video will add it here with the link to the research where there is some written or video form research. So I hope you enjoyed this. You can download this and play around. This is just for educational. There will be errors, I don't guarantee, but just for an overview for me, and then I'll automatically update this on Google, update the templates, and if you go to data, you can automatically update the data, and we will see whether it becomes a real bargain or not over the very long term. Thank you for watching, looking forward to your comments, and I'll see you in the next video.